At this point, it's time we switch our attention back to accounting issues that surround inventory. Everything on this slide is a review of things that we've talked about previously. We'll just go through them quickly. First of all, remember that the cost of inventory on the balance sheet includes all the costs that were needed to get that inventory both in location and condition for resale. So for a retailer or a wholesaler, that generally just included the invoice price, and you would add any shipping costs to get the inventory to the place of business if the company was responsible for paying that, as well as possibly things like assembly. And of course, inventory is an asset on the balance sheet, but as a company sells that inventory, we move the cost out of the asset and into the expense account that's called cost of sales or cost of goods sold. We also saw previously that companies could make a choice with respect to what type of accounting information system they wanted to use for inventory, and those systems are generally described as either a perpetual or a periodic method. And again, what we have used whenever we've done transaction analysis is the one that's a little bit more intuitive, which is the perpetual method. And in the perpetual method, a company is just perpetually updating that inventory account. So they add to inventory when they buy inventory, and they subtract the cost of items that were sold when they sell some of their inventory. And I hope you also remember seeing this diagram before. This is a graphical representation of the cost of goods sold model, which can easily be translated into a cost of goods sold schedule that could be part of financial statements. And in fact, we'll take a look at one of those shortly. The cost of goods sold model, as you recall, basically just said if you've got some beginning inventory on hand, let's say at the start of the month, and you make purchases of inventory during that month, then when you add those two things together, that represents the total cost of all inventory that was available for sale during that month. And everything that was available for sale during that month either becomes the expense, cost of goods sold, or you must still have it sitting on the shelf as part of your balance sheet account for ending inventory. And because both of these things equate to the total cost of goods available for sale, we know that the sum of beginning inventory plus purchases will always equal the sum of cost of goods sold plus ending inventory. And you'll see this becomes important to us later on when we start talking about inventory costing methods. For now, let's take a look at an easy example of how we use that model to calculate cost of goods sold. Let's use an example with an umbrella. So let's assume that you are an umbrella salesperson. You bought 100 umbrellas for $6 each, and we can say this was during a particular month. So you had no umbrellas on hand at the beginning of the month. You bought 100 of them for $6 each, and during the month you sold 70 of them for $10 each. So being a smart business person, you sold them for more than what you paid for them. So you're making a $4 profit on each one of those umbrellas. How would you prepare a cost of goods sold statement with these facts? Well, we could easily compute cost of goods sold here. The words basically tell us what this represents. We want to know the cost of those goods that were sold. So that would be the 70 umbrellas that were sold times the $6 that we paid for each one of those, or $420. Inventory at the end of the accounting period would be what's left. You bought 100. You didn't have any at the beginning. You bought 100 umbrellas. You sold 70 of them. So you have 30 left at the end of the month. 30 umbrellas that each cost $6 means that ending inventory on the balance sheet would be $180. Now let's slip that into a format for a cost of goods sold statement. So cost of goods sold statements, if they're included as part of an income statement, which is where they'd normally be, or just an extra schedule. A cost of goods sold statement is generally stated in dollar amounts, like the bold column here. However, the logic for a cost of goods sold statement also works when you think about just units or number of items. So let's look at this far right column first and make sure the logic makes sense to you. At the beginning of the month, you had 0 umbrellas. You purchased 100. So during the month, you had 100 umbrellas available for sale. If at the end of the month, you count what you have left over, 30 umbrellas, you would be able to back into the fact that you must have sold the other 70 umbrellas. The sum of beginning inventory plus purchases must equal the sum of ending inventory plus cost of goods sold. Then over here we've just multiplied everything by the correct dollar amounts. These umbrellas all cost $6, so everything here is just 6 times the units in the right hand column. And again, we can see that the total cost of goods available for sale is equal to the sum of ending inventory plus cost of goods sold. Well, this is a pretty simple example. I'm just trying to show you how this schedule really matches that graphical depiction that I showed you on the earlier slide. But in real life, things get complicated pretty quickly for almost any business, because what will happen is that the cost of the goods that you're buying to resell to your customer will change over time just due to things like inflation. Let's see how the schedule looks when that happens. So here let's assume we're rolling forward to the next month. Okay, so our beginning inventory is those 30 umbrellas that we had on hand at the end of last month that cost $6 each. So our beginning inventory is 30 umbrellas at a total cost of $180. So of course this month we go out and we purchase more umbrellas. We purchase 50 of them. This month, however, the umbrellas are going to cost us, and we'll assume it's an identical umbrella, but those umbrellas that cost us $6 last month now cost $8 each. So our purchases would be 50 times 8, or $400. We have $580 worth of umbrellas available for sale. 80 umbrellas at a total cost of $580. If we sell 60 umbrellas, what would be our cost of goods sold? Well, there's 80 umbrellas available for sale. If we sold 60 of them, one thing that we know is that we must have 20 umbrellas left in ending inventory. So if you know there was 80 umbrellas available for sale, if you know either the number of units in ending inventory or the number of units sold, you can easily compute the other one. So the other thing we know here is that the cost of whatever cost we assign to the 20 umbrellas that are left in inventory and the cost of the 60 umbrellas that we sold, those two costs have to add up to $580, right? But how much do we assign to these 20 and these 60? We have some $6 umbrellas and some $8 umbrellas. So now it's a little bit messier. How would you do this? When I ask that question in my classes, students will generally ask me back a question, and they'll say, well, which ones were sold? Which ones were they, the $6 umbrellas or the $8 umbrellas? And sometimes I say, let's assume that we don't know. All of the umbrellas are the same color. They were all identical black umbrellas. And you don't really know which ones were $6 umbrellas and which ones were $8 umbrellas. When that's the case, you'd have to just make some sort of assumption. And students in my classroom will generally say, well, let's assume that you sold all of the $6 ones first before you started selling the $8 ones. Or other students will make the opposite assumption and say, let's assume you sold all of the $8 umbrellas first before you started selling the $6 umbrellas. And some students will say, maybe we should use some sort of an average cost. Well, all of those are great assumptions. And in real life, what companies generally do is choose a simplifying assumption to assign costs to their inventory. Choice of one of those cost assumptions is another thing that companies have to do when they've got inventory. So they have to pick if they want to use perpetual or periodic, and they have to choose a cost flow assumption for each one of their major categories of inventory. And they don't have to use the same cost flow assumption. They can use a different assumption for different types of inventory. Once they choose a cost flow assumption, however, they need to use it consistently. Something that's really important to note here, however, is in this box right here. The cost flow assumption that companies choose to use does not have to match the way they actually sell their inventory. So if you were the umbrella seller, standing on the corner in some big city selling umbrellas, you might want to make sure, or as sure as you can, that you're always selling your oldest umbrellas first. And you would do that simply because you know that if you don't pay some attention, the oldest umbrellas might start to get faded from being out in the sun or something like that. So it may be that that's what you generally try to do. However, it's not going to be perfect every time because some customer may just, pick out one of the newer umbrellas even when you have some older ones sitting there. But the cost flow assumption that a company makes, a company can assume for accounting purposes that they sold their oldest umbrellas first, even if that's not exactly how they sold their inventory. The idea behind using a cost flow assumption is to simplify things. And later, after we do many different examples of the various cost flow assumptions, we'll have a discussion about why a company might choose one cost flow method over another. Well, let's go back to that notion of physical flow, or how goods are actually sold. And as I alluded to a few minutes ago in my example about the umbrellas, for many companies, the physical flow is, at least generally, the oldest goods are sold first. In a grocery store, the people working there will rearrange the produce, the milk, whatever, to try to put the oldest stuff in front to make sure that it gets sold before it goes bad. When things look like they're getting close to expiration dates, they'll put them on sale to speed up that sale. Of course, there's going to be the people who come in and always pick their milk from the very back of the case to make sure that they're getting the freshest milk possible. And that's why we're saying that's generally how a company is going to try to sell their goods. And honestly, that's even true in something like a hardware store. A hammer doesn't expire. It doesn't probably really go out of style, but it's still going to get shop worn, and you don't want to have 7 price stickers on it, that kind of thing. So even when you have stable goods, most retail stores like to try to get rid of their oldest inventory first. So that's generally how most goods get sold. The oldest items are usually sold before the newest items that are in inventory. Now, can the opposite ever happen? Is there a case of where the physical flow of goods is generally the newest stuff is getting sold before the oldest stuff? Well, a really easy example is noted here, a gravel pile. So you can picture, a company mining gravel to sell to their customers, and they start out with a small pile of gravel, and then, throughout the day, the week, the month, you've got these trucks dumping newer layers of gravel on top of the little pile, and the pile is getting bigger and bigger. When they sell to a customer, the customer is going to get the gravel that's on top of the pile, or the newest gravel. So in effect, they're selling their newest inventory first because of a physical limitation. That first initial little pile of gravel, that's going to sit there forever unless they completely liquidate their inventory at some point in the future. Well, I've just given you 2 examples of 2 of the most common cost flow methods that are used here in the U.S. FIFO, which stands for first in, first out, and LIFO, which stands for last in, first out. So we'll come back and talk about those 2 methods in a little bit. FIFO basically assumes you're selling your oldest inventory first, whereas LIFO, you cost your inventory as if you sold your newest inventory first. The other two options here are weighted average and specific identification. Weighted average basically uses an average cost of items that a company had on hand and purchased during the period, and you weight them by how many units you bought. So if you had more of one cost than another, that cost would get weighted heavier. Specific identification really isn't so much an assumption. Specific identification would be used, could be used, it wouldn't necessarily have to be used, but it could be used if a company could tell whether or not, for example, it was selling a $6 umbrella or an $8 umbrella. So in order for a company to use specific identification, they have to have some way to tell what they actually did pay for each item in inventory that they're selling. So when a company first acquires inventory, it will choose one of these common methods for accounting for the cost of their goods sold. Remember that the choice can be independent of how they actually sell their items. So they can actually always try to sell their oldest items first and still use the LIFO method, which assumes they're selling their newest items first, or almost any other combination here. The best way to understand cost flow assumptions is to actually see some computations and compare the results across all of these different methods. So that is what we'll be doing in the next video.